Really pleased to be with you all today. Brought two of our best minds to the table today to talk about an economic update and some things to be thinking about as you all embark on your budget and planning cycle for 2025 and beyond. So to join us today, we have Kieran Kinney. He's our treasurer at CoBank, Senior Vice President and Treasurer of CoBank, a familiar face to these webinars if you've done these before. And then Tanner Emke, he's new to this series of webinars, but has been a longtime co-banker since 2015. Tanner leads our grain and oil seeds research and has been an economist on our team for some time now, focusing on a number of different commodity sectors. So pleased to have both of those gentlemen there. Just one note, I wanted to send thoughts to all our customers and friends in Louisiana following Francine yesterday. Hopefully you all are recovering safely and no major catastrophes are underway. So we're thinking about you. So before we get started, Kieran's going to start off with our economic update, but we wanted to start with a polling question. Want to make sure all of you guys got a chance to weigh in on this. We'll do 3 of these throughout the process, so please work on answering these. First question, when do you expect the U.S. economy to tip into a recession? A, we're already there. B, fourth quarter of 2024. C, first half of 2025. Or D, second half of 2025. And then E, no recession, soft landing. We'll give folks a minute to answer that. Gentlemen, anything you want to add before we get going?
I'd like to get Kieran's thoughts on the 2 major signals that everyone watches for recessions, and that is the inverted yield curve and the SOM rule. If you look at those, I think they've been flashing red. I mean, here recently, the SOM rule breached that threshold, the 5%, I believe it was, on unemployment of that increase. Perhaps you can lend your thoughts on that, Kieran, because I think a lot of people have been predicting recessions perpetually and have been perpetually wrong.
No, it's been fascinating. A lot of indicators that we've used to predict economic outlook has not worked like history would suggest, right? And even the inverted yield curve, we've had the longest inversion for more than 2 years now. People have been calling a recession since it went inverted. And we've said that it's not the inversion, but the re-steepening. And so we're beginning to get inclinations of a steepening back. And so the signal is when the yield curve actually ends up going positive. And we got a little bit of positive shape on the yield curve recently, but it's gone inverted flat again. So it bears watching. On the SOM rule, Dr. Sam, who came up with the rule, has said this time is different. There are a variety of reasons, and we'll talk a little bit more about some of those reasons when we talk about the labor market and the employment outlook.
Great feedback. So really quickly, we'll go to the results here. Half of you need to drink some more coffee because I don't see an answer. But for the ones that did answer, E was the most popular, soft landing, no recession, followed closely by first half of 2025. So Kieran, why don't we spend a little bit of time giving some views on the outlook here?
No, thank you, Tamara. So if you were to look at growth, right, growth continues to remain remarkably strong. And so it's consistent with the view that the participants seem to have, which is that things are looking okay, right? You look at growth, and last time we met in the third quarter of last year, we talked a lot about how growth was re-accelerating, even though there was talk about a recession back then as well. And as you can see, what ended up happening in Q3 and Q4 of last year was very strong growth, right? There were clearly one-off factors that led to it, but that trend continues. If you look at Q1 and Q2 of this year, we're averaging north of 2%. And if you look at Atlanta Fed GDP now, that's showing third quarter is tracking 2.5%. So there's really no inclination that we are approaching a recession. Growth should slow down. That's what the Fed is trying to do, right? Also, the thing I note when you look at the screen is the first quarter was negative, but look at the sectors that are dragging it, the orange and yellow bars, which are exports and inventories, which tend to be volatile, right? So the Fed likes to look at a real private domestic final purchase. If you look at the minutes, they talk a lot about this. This is true domestic demand. And you can see that growth by this measure is tracking 3% in the second quarter of this year and remains close to the highs we saw during a very stable period when the Fed was on hold between 2010 and 2019 pre-pandemic. So if you look at the underlying drivers of growth, they continue to remain very, very strong. If you look at things like ISM surveys, which are forward-looking indicators, the services component still is expanding. So if the way you read this is a number above 50 indicates expansion, number below 50 indicates contraction. The blue line is ISM manufacturing, and you can see it's been below 50 for a period of time. Manufacturing has continued to lag, right? But historically, we're not a manufacturing economy, right? A lot of what the US economy is driven by is services, and services sector continues to hold up pretty well. Not gangbusters, right? But not indicating a recession either. So this forward-looking indicator seems to suggest that growth will continue for the time being. The one thing we would caution is around excess savings, right? You've looked at a version of this chart before. The chart on the left shows you excess saving buildup and drawdown. The chart on the right shows you a cumulative view of the same numbers. So during the pandemic, as you remember, because of fiscal transfers and not being able to go out and spend, all of us ended up saving a lot of money. There was nothing we could do, right? We went out and bought goods for a little bit, but there's only so many TVs you could buy, right? We typically consume services, and there was really, when the economy and we were locked into our homes, we just sat on the sidelines. And once we were let out, we spent all that money very, very quickly, right? That led to the inflation surge we saw and the strong growth we saw. But if you look at it, right, as of June 2024, and this is numbers from the San Francisco Fed, shows that the excess savings is actually now a deficit. So excess saving has run off. The thing that supported strong consumer consumption over the last many quarters is showing signs of at least being tapped out.
Karen, maybe it's a time for a good question I saw pop up in the chat. We talked about growth and what those numbers mean, and sort of how do you reconcile, or how do you think about what those numbers show versus what it feels like consumers are still feeling, which is a little bit of struggle, a lot of inflation impact. You know, how do you sort of estimate or assess what that looks like and how that's sort of playing out?
Yeah, I think if you look at it, and I don't have a chart, unfortunately, but if you sort of break down consumers by income, people at the bottom end of the income spectrum are really struggling, and it sort of works its way up to the middle and to the top. People at the top are doing well. If you own assets in any form, housing, stocks, etc., they're all doing very well, right? They're at record highs. And so consumer balance sheets in total are very, very strong. We are seeing stresses on the margin, right? You are starting to see. And so it depends on where you are geographically, income spectrum wise, and what you're hearing anecdotally from the people you interact with is going to be very different, right? A lot of these data tends to give you a view of the US economy in aggregate. And in aggregate, we're doing fine, right? Doesn't mean people are not struggling. So building on that, you can see, right, as consumers started running into their excess savings, you started to see debt buildup continue to go up, right? You can see that on the chart on the left. Total debt continues to go up, and we just got July's number for consumer debt went up by another 25 billion. So consumers continue to borrow to spend, right? It's hard to get out of your spending habit. Like if you're used to going out to eat 3 times a week and you run out of savings, it's very hard to say, well, I'm going to start saving. You just put it on your credit card. Maybe you go out 2 times a week, but you don't go cold turkey and go to zero. But you can see consumers are starting to feel the stress. If you look at the chart on the right, you can see credit card delinquencies are starting to pick up. Right, you're seeing the green line is auto delinquencies. Auto delinquencies are starting to pick up. Autos in particular are worth watching because we all know what happened with auto prices over the last couple of years when they skyrocketed, and people really stretched to buy cars, right? In spite of high prices, people took on debt to buy those, and those payments have gone up from $200, $300 on average to $600, $700 on average because of higher interest rate and higher car prices. That is not sustainable. So that's something I'm watching closely for early indicators of consumers really starting to feel. But a lot of the data on the auto side is showing weakness. But again, like I said, it is the bottom decile that is starting to feel that weakness, not on average, right? On average, we continue to do well. So,
Karen, so one question that kind of came up, maybe just level setting. When we talk about excess savings, what does that really mean? Does that mean anything in savings, or sort of what's the definition of that?
So the way the San Francisco Fed estimates that is there is a trend rate of savings that Americans typically do, right, based on history. So they use that as your baseline and then say, compared to that baseline, as the economy grows, we should be saving a certain amount as income and economy grows. So that becomes your baseline projection of savings. So anything above or below that is what's designated excess savings. So that's truly viewed as disposable income, right? Because if you're saving for a rainy day, if you're saving for college, all of that is just part of your regular discipline of saving. Right? So it's anything above which ends up being discretionary from a spending standpoint.
I got a question on wages. Wage growth isn't helping the U.S. consumer here?
Wage growth has helped. The problem is real wage growth has not gone up until recently, right? If you remember, even though wages were going up 4, 5, 6%, inflation was going up 7, 8, 9%, right? So real wage growth was actually negative. That was leading to people to have to tap into savings to meet their daily expenses. That has become a positive tailwind because inflation has come down to a 2 handle while wages still remain closer to 4%. It remains to be seen, and we'll talk more about the labor market and the changing dynamics in the labor market to see how sustainable that is. But that is something that is going to be a positive tailwind, is the fact that real wage growth is starting to pick up because inflation will come down and wages are still growing at a steady pace.
You know, Karen, the interesting thing that we probably all observed and felt during the pandemic is that you couldn't get a new car to save your life, right? There was just not inventories that existed. And then I think they kind of went into hyper production mode, and maybe now there's cars sitting there for a while that, you know, people aren't taking, or as you've shown, people are taking out loans to buy new ones. What do you think that does? I mean, that's just one data point, right? Is sort of the auto loans perspective, but from an inventory standpoint and company management of inventory, you might think that that would cause prices to eventually go down. How sticky do you think those prices might be?
Well, I think that's a risk, at least on the auto side. Like what I've learned from our customers on the ag side is the saying, the cure for high prices is high prices, right? And people reacted and started putting more goods into the economy, right? And as the economy opened and those supply chain issues started to get resolved, you are seeing prices come down, right? That's part of the reason behind why inflation has come down, is the easing of the supply chain. So even though demand has remained robust, inflation has come down because of the continued improvements on the supply side of the equation. Remains to be seen how much more there is to go, right? Autos are just a small component of the consumer basket, right? We are seeing food prices come down, at least on the commodity side, it's come down, not necessarily on the grocery side, but eventually that should catch up, right? As the commodity prices come down, that feeds into the grocery prices, and people hopefully get relief. And we'll talk more about inflation in the next section. So let's tee up inflation. And if I don't get to your question, please do remind me and we can talk more about it. Right. So looking at inflation, inflation picture continues to improve. I've labeled 3 red lines, right? The first line was late last year when we were having the same conversation a year ago. Inflation looked like it was coming down, right? And one of the things we cautioned about was be careful, right? It's too early to tell that inflation is on a sustainable path. But the markets did get excited by year end. And if you remember, when we walked into January, market starts, the Fed were going to cut immediately, right? We had 7 rate cuts for 2023 priced in. And then you saw inflation start to go back up. There were structural issues that continue to hamper the fight against inflation. And you saw inflation go up, and it wasn't as late as May when there were a few Fed speakers arguing that the Fed should raise rates. right? A very significant difference from where we are right now. But that was because inflation looked like it was going to remain sticky at a higher level and was actually turning and going up. And now it looks like inflation is on a sustainable path down. So that's positive. And that's why when we get to the Fed section, you'll see the conversation is about how much is the Fed going to cut and how quickly are they going to cut as opposed to will they cut, right? So clearly the Fed feels very comfortable about the trajectory inflation is under. And for the conversation we were just having around some of the drivers, it is coming from the supply side improvements. And the labor market stabilizing. So a lot of tailwinds for inflation. Some of the concerns that the Fed had about inflation being sticky at higher levels is starting to get alleviated. What you see on the screen is month-over-month changes. We like looking at month-over-month changes because, as you can see, the numbers have been very volatile. And so when you look at year-over-year changes, base effects come into play. Where was inflation a year ago? And so you could see the numbers bounce around. And so just looking at it on a month-over-month change allows you to then annualize it and take near trends into account. What the Fed wants to see is the month-over-month change somewhere between 0.1% and 0.2%, because 0.16 is effectively 2% annualized. And so the Fed wants to see numbers in 0.1 and 0.2. You can see core CPI ticked up to 0.3 in August. We just got the number yesterday. And so that tick up is why the market is shifting conversation towards the Fed going 25 versus 50. And we'll talk more about it when we get to the Fed section of this conversation. But inflation overall remains on a good trajectory. And the reason the Fed feels very confident on inflation coming down is the lagged effect of rent, right? In the CPI, rent is about a third, shelter is about a third weight, right? 35%. And we've talked about the lagged effects of rent and how so I won't dig into it, but you can see that the Zillow rent index is much lower than the rent component of CPI on a lag basis. And so if nothing happens overall, the red line should start moving towards the blue line, and that should cause CPI to come down. And that's what gives the Fed confidence that inflation is on a sustained trajectory back to 2%. So we'll flip to the second part of the Fed's mandate, right? Clearly, the Fed has gotten more comfortable with inflation heading towards 2%. So now the focus is all around employment, right? If you look at the labor market, and again, this is a chart you've seen before, the green line is an average of the other two lines, the unemployed and job openings. So how many jobs are open per person looking for a job is what the green line tells you. And at its peak, there were 2 jobs open per person looking for a job. And that number is now at 1.1, right? It's a fairly well a labor market that's in balance and at levels consistent with where we were in 2018 and 2019, right? At that time, nobody thought that was an overheated job market. And so we're back in balance on the labor market. This is an area where a lot of conversation recently around the surge in immigration that has led to some of this healing, right? We've seen a lot of last time we had this conversation, we talked about how there's a shortfall in the immigrations during the pandemic. Over the last 2 years, with hindsight, we've seen significant number of increase in people coming into our country, both legally and illegally, but bodies available to do work, right? And the economy has benefited from that. And that's helped to the healing of the market. And that's one of the reasons why the indicators like the Sahm rule have struggled, because most of the time unemployment goes up is because of layoffs, right? It is mostly on people being let go, which has income effects, which leads to spending effects. And this time around, the unemployment situation is improved with people coming in mass into the labor force. Very different dynamics because these people who didn't have jobs don't have jobs. Doesn't change their income profile, doesn't change their spending profile. And so that's why indicators like the Sahm rule has struggled, because a lot of the unemployment rate going up is with people coming back into the labor force as opposed to people being let go and being out of a job, right? And so doesn't mean it's not a concern. It just that explains why we haven't seen a consumer spending slow down. If you look at non-farm payrolls, again, continues to grow at a fairly healthy clip, right? The 6-month moving average of not payrolls has been around 164,000. The unemployment rate has ticked up, right? Has gotten to a level where the Fed is starting to get cautious. 4.2 is where they view as long-term stable rate of employment. This is from their economic summary of economic projection, or the dot plots that we get out of every other FOMC meeting. And we should get an updated number at the upcoming September meeting next week. But one thing to caution is these numbers do get revised, right? So the numbers you saw on the last slide were post-revision numbers, but we typically react to the numbers as they come. So we get excited when the number is 150 and if it gets 400, you start to say the labor markets or interest rates start to sell off, right? Word of caution is these are numbers are very volatile. And as you can see over the last 18 months, the numbers have been revised down by a total of 725,000 jobs, right? Which is about 50,000 jobs, 60,000 jobs a month. A very different reaction profile if you knew that the numbers were weaker than the first time the numbers came. So take these numbers with a grain of salt. Also explains why you've seen the unemployment rate go up while the labor market continues to show significant jobs being added.
Hey, Kiran, I'll take a pause right now and ask a couple questions that have come in that I think are worth touching on.
Yeah.
And this is, Tanner, you too, feel free to chime in. Do you think that the weekly jobless claims number is a good leading indicator, or are there flaws with that look at that number?
The unemployment rate, Tamara?
The weekly jobless claims number?
Yeah, the weekly jobless claims number gives you it is a good indicator, right? But again, in a market where a lot of the supply has come from, let's say undocumented immigrants, they don't file for unemployment claims, right? So it gives you a misleading picture of slack in the labor market. A lot of people are available to work. A lot of people don't have jobs, but they are not the usual, the way you see them in the numbers, right? And so it is painting a true picture of layoffs or people losing jobs, but it's not telling you the complete story of what's going on underneath the surface of the labor market. Tanner, I don't know if you have any thoughts.
I was going to ask something along those same lines, Kiran, about a lot of the undocumented immigrants. When I go to Home Depot, there's a lot of gentlemen out there standing alongside the curbs, willing to help you out with whatever house project that you have. Those gentlemen are not being counted as unemployed or employed. They're not recorded.
Well, many of them are showing up in the surveys, right, in the unemployed and the total available labor force, because those are all coming from phone calls to people, right? And so these are based on statistical measures. So the payroll survey, which is based on companies filing, which is where the headline numbers come from, that doesn't capture those kind of workers. But the household survey, which is based on a survey methodology and calling people, that does tend to capture some of these dynamics, right? And so that's why you're seeing the unemployment rate go up, because those people show up as unemployed. They show up in the total labor force, but that's the disconnect between the non-farm payroll, which comes from companies, which doesn't capture it.
Right. Thank you.
So continuing on, if you look at the sectors that have added to jobs over the last 12 months, a significant portion has come from sectors that you typically don't consider cyclical, right? Look at government being the second largest creator of jobs. That's not a good thing, right? We don't want our government. We want industry to be adding jobs. Also, private education and health services are acyclical sectors. And so a lot of the job creation is coming from acyclical sectors, while the cyclical sectors tend to lag, right? Another indication that what the Fed is trying to do is working. The economy is slowing down, right? The question is it slowing down enough to get us into recession? Doesn't look like it at this time, but doesn't mean we don't have problems, right? One of the things that the Fed is really concerned about is this chart, right? The way to read this chart is on the y-axis is job vacancy rates, and on the x-axis is unemployment rate. There was a lot of concerns when vacancy rates started to fall and people thought this curve was much flatter. It's called the Beveridge curve, that unemployment was going to go up a lot. And Governor Waller was one of the proponents who said that no, it's not going to go up over the last year, that a lot of it is going to be companies who have open jobs just won't fill them or will get rid of them, as opposed to lay off people. And he was proven right? You can see the red dots are dots from March 2022 to April 2024 as the labor market healed. A lot of the vacancies either got filled with people or they were removed as vacancies. And we didn't see a significant increase in the unemployment rate as the vacancy rate fell from almost 8 down to 4%. But the Fed needs to be cautious. We are at the flatter part of the curve. Any further declines in the vacancy rate from here on could lead to fairly significant increases in the unemployment rate. And that's what making the Fed cautious. So with that, we'll flip to the dual mandate, The Fed has a dual mandate. Their goal is to keep inflation at 2%, as well as keep full employment. And for now, they're defining a full employment at 4.2%. And we are right there. So at Jackson Hole, when you had the Fed chairman speak, he had some strong words. This initially got a little bit of underplay, but everybody now is focusing on these words, These are strong statements for the Fed to say, given that they've been battling inflation and they've been letting the labor market take a back seat. This was officially them saying, we are good with inflation. Our concern is completely shifting to the labor market right now. And that's because of the curve we just showed you. We are at that tipping point where any further deterioration in the vacancy rate or in the labor market could lead to significant increases in the employment rate. And that's where the conversation is going, One way to look at it is to look at the two together, Inflation is the red line, and this is PCE. So we've talked about CPI before, but this is the Fed's preferred measure of inflation, has come down from 7% in 2022 down to 2.5%. Not all the way down to 2%, but like we talked about, tailwinds are supportive of directionally continuing to go there. The problem they're having is unemployment has gone up from a low of 3.4% to 4.3%, ticked down to 4.2% in August, but at or above their level of full employment. And that's the reason why you saw the Fed chair talk strongly about the labor market, and that's the shift in sentiment in the overall interest rate markets in terms of what the Fed's going to do. With that, poll question number 2, Looks like it's getting ready to be open, but the question for you all is, now that the Federal Reserve is on the verge of beginning their rate cutting cycle, how low, What is the terminal Fed funds rate do you expect, How low for this cycle do you think Fed is going to cut when they start? And you can see the options on the screen, so I won't read it out, but I'll let you answer these questions. Tana, what do you think? Where do you stand on how low the Fed's going to cut? And Tamara, you too.
I was going to ask you, Kieran, here recently we had the big scare in the market, the unwinding of the carry trade when the BLS came out with that shockingly low number on hirings a few weeks ago. And then the markets kind of lost control for a little bit there, and everyone was screaming that not only are we going to see a rate cut start in September, not only is that guaranteed, it's going to be a 0.5 point. It's going to be 50 points.
Yeah, it was interesting, It was backwards in the sense that the reason the market thought that the carry trade was getting unwound is because the Japanese yen was strengthening because they were raising rates and their relative rates were going up. And so it wasn't clear to me that us cutting rates very aggressively solved that problem. If anything, it made it worse because the yen would appreciate even more, which means the carry trade would unwind. So it was sort of counterintuitive on what the prescription from the markets was for the problem we were having at that time, The other thing that the Fed needs to sort of think about and be careful in this rate cutting cycle is that income is also benefiting from high interest rates, especially in money market funds, There's a lot of money sitting in money market funds that's earning interest. And to the extent the Fed cuts rates very aggressively, that income will come down immediately, At the same time, it's unclear if the benefits will come at the same pace as which income is going to come down. And it's possible that the first effect, sort of a J-curve effect, is that when the income coming down actually makes consumer spending worse, before some of those long-term benefits from lower mortgage rates and all flow through the economy, right? There tends to be a lag on that. So one of the reasons why I think the Fed should be more methodical and not aggressively cut rates is to be mindful of some of the income dynamics as well. Given that majority of Americans still have low mortgage rates, right? A lot of the stress is on the margin, not necessarily at the core of the issue right now from higher interest rates.
And if they came down with a heavier than expected cut, perhaps that might send the wrong signal.
It could, right? And it could bring inflation back. So there's a lot of things that they need to be very mindful of here before they start to think about rate cuts.
So Kiran, one point of clarification here. We're asking, what are they cutting the Fed funds rate to, right? So what would actually be the ending rate, not necessarily the amount of the cuts that are going to occur, right?
That's correct. Where do you expect Fed funds to end at the end of this rate cutting cycle? Right. And we saw that go all the way down to zero during the pandemic, right? It's just to get an assessment of how different do we expect this cycle, our participants, this cycle to be than past cycles, right? Have we gotten used to low rates and have the bias that once they cut, they're going to go and cut very aggressively?
All right, so it looks like the majority of folks answered in number or in letter A or letter B. You want to give us your insights?
Yeah, no, it's interesting, right? So it is in line with where the markets have been, not where they are right now, right? So if you sort of look at it, most people think that this cycle is going to be much more benign easing cycle than we used to, right? And which makes sense, right? So let's switch the conversation. We'll sort of talk about it as we go through and take a look at where the markets are, right? So as of May 29th, before the markets, everything started to go crazy, the market was consistent with what our participants seem to think, a gradual rate cutting cycle bottoming out right around 4%. But look at where we are now as of Sep 6, right? Markets are expecting Fed to cut all the way down to 290. Right, a fairly significant shift between where we were in early June to where we are now. Part of that, and the green line is where what Tanner talked about, the carry trade unwind, right? So we are actually now below that one-day panic in the market in terms of what the Fed's going to do. And if you look at the table on the right, top right, you can see some probabilities based on the CME FedWatch tool is that 87% think it's a 25 basis point cut at the upcoming September meeting. But you can see the probabilities really go up for 50 for the next two meetings, right? The total cuts price between now and year end is a little more than 100 basis points. So closer to 125 basis points, which means 250s and 125, given we have three meetings left, right? So the markets are expecting very aggressive, and we're sort of a little surprised by it. We understand, right, why the markets are getting a little panicky. Was very surprised that the markets were pricing in a 50 for the SEP meeting. Like we said, growth remains okay, right? It's not falling off a cliff. Unless there's a crisis, the Fed typically doesn't start with big moves. And it is a consequential election year, right? And we'll talk about some of it in the structural section. Optically, going 50 when the economy is doing well ahead of opens you up for political noise. Even though the Fed is not a political animal, you don't want to sort of wake up that beast, right? You don't want to go 50 when there's really no need to do it. There's no signs. And so it was very surprising when the markets are aggressively pricing 50 for the SEP meeting. But what the markets have done now is sort of push that back and say, listen, once the elections get over, it frees up the Fed. And so you can see November and December seem to be pricing in 50, very high probability of 50 at both those meetings. We think the markets are getting a little too far ahead here. Doesn't mean that this scenario couldn't play out. And maybe it's pricing in an asymmetrical distribution to the downside in the labor market getting significantly worse. But our initial read is we're getting ahead of ourselves here. We agree with our participants and their views that there is about 100 to 125 basis points of ease for the Fed to take out of the markets, right? There's been a lot of tightening and inflation has come down, and that's given the Fed some leeway to sort of cut rates without significantly loosening policy. What you hear from Fed speakers is that they want to normalize policy, not ease policy to accommodate them, right? And so a very different view than what the markets are taking. It feels like markets are positioned wrong and they've overdone it. And as we get more data, it's likely that some of this comes out. But for now, given we have a very consequential election and significant shifts in policy, it feels like people are buying insurance in very short dated space, right? It doesn't cost you a lot if you're wrong, if you're betting that it goes 50 for 2 months, right? Versus betting on rates for 10 years. So I think a lot of people are shifting their bets to very, very short data to take advantage of asymmetry as opposed to expressing a view. And that's what you're seeing in the markets right now. So if you flip to the next slide, building on it. So if you view, right, if the group here seems to think that Fed funds at the end of the cycle is only going to be 350, right? So you should be shorting everything first, right? Rates are mispriced if you think that's the low of the cycle because you have 2-year notes trading right there. But one of the things we wanted to have a conversation around is where should the rest of the yield curve trade, right? In the past, we've talked about building it using real rates and inflation expectations and term premium. We just wanted to take a different tact on the same thing based on market rates. So if you look at historical cycles and look at where 2-year treasuries trades at the end of a Fed easing cycle, somewhere between 25 basis points and 100 basis points over the low point of the cycle is where 2-year treasury notes. The exception is 2020 because of the massive amount of quantitative easing and the uncertainty the pandemic caused. But away from a period where there's quantitative easing going on, there tends to be a little bit of slope between policy rates and 2-year notes. So if you say, if this group thinks that 350 to 4% is where policy rates are going to end, then 2-year notes at the bottom of the cycle should trade 375 to 425, which is lower than where they are right now as we speak, right? So you can see the mispricing in the market given the view that this group is postulating. Right, then building on the same thought process, some of our people on the call care where 10-year notes should trade, right? So let's look at the yield curve, 2 cents, and see what happens. The curve tends to steepen, right? We all expect the curve to steepen, but the curve tends to be very steep at the end of rate cutting cycles. You can see when the Fed funds reach, you have rates north of 200 basis points between 2s and 10s. Even if you take the right side post-pandemic and say it should be 50 to 150 as your proxy, and we just built up from the terminal view from this group to 2 years and said 2-year notes should trade 375 to 425. And even if you add 50 basis points to that, you're talking 425 to 475 for 10-year yields, right? Which is way about where they are right now, right? So one of our concerns is that it's unclear there's a lot of upside left in the market at current rate levels, right? For rates to make sense, one of two or both need to happen. Either the market needs to think the Fed's going to terminal funds rate very, very quickly, right? Faster than where the markets are currently priced, or they shift their view that terminal rate is actually lower than the 290 that the market is pricing, and we start opening up a hard landing scenario, right? That we need to start thinking that the Fed is actually going to cut into accommodative and push rates below 2% to justify where rates are trading. It's possible, there's some probability that that happens, but for now, again, it seems a little premature given everything we're seeing in the economic data as of now. So if you look at 10-year treasury yields, like we said right now, technically, the charts actually look like we have some more rally left, right? So if I zoom into the red circle that you see on the screen and keep mindful of that blue trend line, you'll see a glimpse of it at the bottom on the next slide. You can see that rates are broken down below the 380 level that we've been watching for some time. It's been hard to maintain rally, but it seems like the momentum is to lower rates and explore that 350 to 330 band. It likely happens if the Fed were to surprise or we get a data point that is very, very weak, especially on the labor market side. But like we talked about right now, it's unclear how that's sustainable, right? Even if you get a few data points that's weak, unless it materially changes the market's view on what the Fed's going to get to, it's unlikely that level will be sustained. But it means that if you get to 330 to 350, opens up an opportunity for people to take advantage of those rate levels to lock in rates if that's something that you're planning on doing. Even at these rate levels, it looks like the market is overdone given the commentary from our participants today in terms of what they expect rates to do. But doesn't mean the market doesn't have some momentum here, and we could explore 350 before all is said and done.
Yeah, so Karen, that's a great point I want to emphasize. A lot of the folks on the call, particularly in our space, are thinking about, planning to pull down funds, planning to think about what the next year looks like from a capital expenditure standpoint. So from your view, if things get between that 330 and 350 range on the 10-year, that's maybe that's a good place to be sort of looking for things to go to, right? From a rate standpoint. Any thoughts on it going lower or sustaining above that 350 level for a period of time?
Yeah, again, I think rates probably stabilize in that 350 to 450 level. One of the issues outstanding is some of the structural issues that Tanner will talk about, right? And so I'll defer to him to cover some of that, right? But the election matters, right? We've talked a lot about economy, data, inflation, right? But focus is shifting. We have a very consequential election coming up, not consequential in the terms of who wins, but the policies that come out of those scenarios. So let me turn over to Tanner to take the polling question, and then we'll talk about some of the structural issues. Tanner, over to you.
Thank you, Kieran. So on that note, yes, we've got a lot coming at us here in the next, is it 55 days? Is it 54 days? Let me move this over. Here we are. So here's the polling question. Do you expect either party to sweep and have control of all three, that's the House, Senate, and the presidency, branches of government following the upcoming elections? A is yes, B is no. And this is something that, something that we watch, something the market watches. I remember not long ago, people had talked about the Trump trade, right? What that really means is a Republican sweep. Is that right, Kieran? That's how a lot of people interpret that. It's not necessarily who wins the presidency, but how much power the person in the White House actually has, and that's going to depend upon who wins Congress.
I think that's right, Tanner. One of the concerns in the market, because it feels like, given how this election is shaping up, it's either going to be a split government or a Republican sweep, right? And as polling indicated early on after the debate, where between the previous debate between President Biden and Trump, it led to the market believing that the odds of a sweep were going to go up, and you saw what interest rates did. A lot of that has to do with some of the things you're going to talk around on the fiscal side. Right. So a lot of concerns around what does the election outcome mean to some of the structural issues that we're going to talk about in just a second.
Amber, do we have is the polling in?
It is. And the most common answer was no. What do you guys think?
I can't disagree with that. And I'd say, from what I've understood from in the marketplace, the market prefers a divided government. That means no one party can just run with policy.
I think that's right. I think that's consistent with where the betting markets are right now, right? And I think a divided government with nothing getting done means they can't screw up any more than they already have, right? And so I'm sure you're going to talk about where we are and all the disaster that is the federal government.
Yes, my favorite topic. Okay, so with that, let's move on. We got a few things here that we're going to cover in a short amount of time left. Just a handful of slides on structural challenges that are on top of all the things that Kieran has already talked about. Kieran's gone very deep with great detail on what's going on in the economy, but larger view. There's some things that we have to keep an eye on. And here's a list of things that we're watching. Obviously, the fiscal situation is not good here in the United States. Neither is it good anywhere else in the world. But that's not to we don't want to let ourselves off the hook here. The United States has lost its ability for fiscal control. We're going to touch on that here in a moment. Demographic situation, basically an aging population. That's true for the United States. That's true around the world. And then also immigration on top of that. How do those two dynamics fit together? Geopolitical issues. Ukraine and Russia is ongoing. There appears to be at a stalemate. We have the Middle East tensions that risk inflaming across the oil exporting region, oil exporting regions. And of course, China and Taiwan. Will China invade Taiwan? That question is always hanging out there. Our contacts tell us it's not going to happen. Other people say that Xi Jinping has planted that flag and he's going to make it sure it happens. Again, geopolitics is just like markets. It's highly unpredictable. And then, of course, election season coming up here just in November for the U.S. But globally, keep in mind, this year, 2024, has had more elections than in any other year in history. Over half the world population is having elections this year. And so that adds another dynamic of uncertainty of how things shake out geopolitically. And then, of course, these geopolitical issues affect what's going on with globalization in our supply chains. And are we deglobalizing, or is it just a new flavor of globalization, like slowbalization or friendshoring? This adds more uncertainty into our supply chains when we have these geopolitical issues between the United States and China, the world's two biggest economies. That's going to have reverberations around the world. When these supply chains divert away from China or away from the United States, where are they going? They're going to Southeast Asia. They're going to Mexico, places like that. And what happens to the supply chain? Is it getting longer or shorter? Well, it's getting longer, right? And when you add length to a supply chain, you add risk. Okay, so more risk. That's typically not good for the business environment. The green energy transition, going back to the election season, what's going to happen to our green energy transition and the IRA and some of the carbon credits, things like that we've watched closely that affect our customers. Another volatile year because of the election season. And the Chinese economy, of course, always hanging out there as what's going to happen with the Chinese economy, especially with the real estate sector being so over indebted. And you have a lot of demographical issues there with an aging population, a very high level of unemployment or youth unemployment in China. So that adds another dynamic there of uncertainty geopolitically and economically. And then, of course, artificial intelligence. The robots are going to take over the economy, and we'll all be looking for a job. Or maybe not. Maybe it makes our jobs easier and we become more efficient and productive workers. I think the latter is probably where that's going to end up, although there will be some workers who do get displaced. Moving on just to the main issues at hand that we think are going to be impacting the economy going forward here is the main one I mentioned earlier is the population is quickly aging. The United States is just one country of many experiencing this. As you can see this on the screen, births minus deaths. We're going to be at a net loss here very quickly in the next, call it 15 years. The only reason we're growing as a population, as a country, is because of immigration, legal and otherwise. As Kieran mentioned earlier, when you're adding bodies to an economy, you're going to grow the economy because you are adding workers and consumers. So that's been a tailwind for our economic growth. Policy may affect some of these things as well. It may affect immigration, but rest assured, we are going to continue to have an aging population. This is not escapable because of our declining fertility rates in this country. It's very expensive to have a family. And that's what the implication here is with an aging population. We're going to be spending more on the entitlement programs, healthcare programs like Medicare and Medicaid, and then, of course, Social Security. Then you add in net interest. That's not something we have a political decision on. Interest has to get paid whether we like it or not. It doesn't matter who's in office. So you add those three things together, and at the end of the next 10 years, that's going to be about 3/4 of the U.S. federal budget. That doesn't leave a lot of room for cutting on discretionary spending. Okay, so what does this mean going forward? We're going to be probably taking on more debt, to pay for these entitlements and to pay for interest on our debt, or we're going to have to be raising taxes. Neither one of those is going to be a positive on the economy. Federal deficits continue to go up, irrespective of who is in office. Doesn't matter who's in office, whether it's a Democrat or a Republican. The bottom line is, if there is a politician in office, that means debt will be going up. That is an inescapable truth. Now, I know there are political leanings, of course, among everyone watching the webinar right now. But the data is right there on the screen, folks. It doesn't matter who's in office. Debt goes up because whoever is in office is trying to fund their political initiatives, and debt is usually the way they do that. As a result, federal debt as a percentage of GDP is expected to continue to grow. This is the latest numbers from the CBO, the Congressional Budget Office, a nonpartisan organization. As you can see there, we're expected to go well past even those peaks during World War II. So anticipate going forward that this is going to be a drag on the economy, because more and more of our money has to be going to paying off debt, okay, instead of being injected into the economy. It's not just the United States, it's a phenomenon around the world. Part of this was driven because of COVID and zero interest rates around the world. And so when money is cheap, what happens? People are going to borrow more of it. Going forward, you can see here, these are the forecasts. This is forecast from the IMF, the International Monetary Fund. Debt as a percent of GDP is going to continue to climb globally for the same reasons that we see here in the United States. Aging population, rising spending on entitlements and pensions, and we're going to have fewer workers paying into the system at the same time. Complicating this situation is the loss of some of your major buyers of U.S. debt, such as the Federal Reserve or foreign official buyers. And we're switching over to more sensitive buyers, okay? People that are going to be more price sensitive. And what does that mean going forward? Well, we're going to have a situation of rising levels of debt with more sensitive price shoppers of that debt. And so the consequence here is rising yields. So going forward, we can anticipate that these structural changes are going to be putting upward pressure on cost of funds going forward. And unless something dramatic were to happen, if politicians all of a sudden decided to be fiscally responsible, which I don't see coming unless anyone wants to disagree with me, we can anticipate that these pressures are going to remain intact for the foreseeable future. Please don't blame your banker for the rates. These are structural issues, and we're all swimming in the same ocean, dealing with the same problems. Tamara, I'll hand it over to you, or Kieran, if you have any comments or anything.
Yeah, there was a few thoughts on the chat around the political parties. Just trying to cover some of that. It's in nobody's interest to address this problem, right? Politicians get elected for short periods of time and they want immediate payback. And these are structural issues that take time to solve. We're talking about decades, but small steps need to be taken now to lessen the burden in the future. And politicians on both sides of the aisle don't want to have those difficult conversations with constituents, because it's a surefire way to not get elected, right? And nobody likes tax hikes and nobody likes spending cuts, right? A good example, anecdote I like to use is I have a 17-year-old daughter who works retail part-time, and when she got her first paycheck, and she's very liberal, like she's as liberal as they would come. When she got her first paycheck, she called me and she was all in panic. She looked at her and said, "Where did all my money go?" Right? She saw the top line on what she earned, and then she saw what was credited to her bank account. And I told her, all these programs that you support, this is what they take your money for. And she was really unhappy, right? But it shows you that everybody wants everything, right? We don't want to spend money, but we want to support the variety of causes. And that's the disconnect, right? We need leaders who are willing to have tough conversations with the country. And we just don't have those, right? And that's why the best thing we can hope for is a divided government which means that they fight among themselves and don't spend our money, right? At the end of the day, that's what we want.
Exactly.
Well, and the other thing to keep in mind is if there was an easy solution, someone would have already done it too, right? It's complicated. It has many layers. And it's, as you pointed out, none of those are popular discussions to be having when you want to get people on your side to put you back in office. And so that continues to perpetuate a problem overall.
And the market is going to be the one that delivers the answer then if we can't. And we're seeing that now.
Yeah, or the market forces your hand. We've talked in the past about the issues in the mid-90s when interest rates went up 200 basis points and forced the market politicians to have a conversation about debt, right? You remember the bond vigilantes, the term was coined in the mid-90s, and that led to people getting serious about the deficit and actually balancing the budget. Into one of the slides Tanner showed, you did see some green bars in the early 2000s. We did get our act together, right? We just need the political will. And if we don't have the political will, the market eventually will say, we're done subsidizing you guys, right? And you saw the cost of debt has gone up, but the risk is that given this is a structural issue globally, that what happens if interest rates goes up 200 basis points over 6 months? That wakes up a lot of people, right? That's the thing we are concerned about, right? As you look at it and say rates are at 350, are they going to go down another 15, 20 basis point, right? The structural issue is, what if rates go up 200 basis points, right? That's the thing you need to be mindful of, is because that's something we don't control. It is a tipping point where we have shifted from price agnostic buyers to price sensitive buyers. And when those price sensitive buyers go on strike, yields can go up very rapidly. You don't know what triggers it, but when it happens, it can change very, very quickly.
Excellent.
Thank you,
Well, I
Karen.
think that's all the questions that we have for today. I wanted to thank our two economist panelists for weighing in on what they're seeing and giving our customers and our partners a feel for what to expect into the next few months and going into the next year. Thanks to everyone for joining us and for the insights, Tanner and Kieran.